So today I got a video that is not good news. In fact, it's going to be a bit more of a negative video, and you guys know me, I'm normally quite bullish. I'm bullish on the stock market. Even through 2022 when the stock market was going down, I was buying a lot of opportunities. I was staying bullish in the long term. Even through the kind of CV situation, I thought, you know what, we're going to be okay here. Buying heavily through the CV situation. This today is the most bearish and probably the most negative I think I've ever been on the YouTube channel that I'm about to say here. I don't have good information today. Now, don't get me wrong. I don't want to go all panic mode. I don't want to go all panic mode on you, and I'm not going to come out here and say that I'm selling all my stocks. But I am seeing a few negative things in the market right now. And for me personally, like I said, it's probably the most negative and the least bullish I've been for a while on the stock market. And today I'm going to show you why those things are, or why I'm thinking like that, and also any actions that I'm taking just to be a little bit more cautious in the next 6 months. So I hope you enjoyed the video. Let's take a look. Now there's two things here. There's the US market and the UK market. Sometimes people get confused what I am kind of talking about. I'm going to talk about the US market, I'm going to talk about the UK market. So I'll cover both of them in this video. So start off with the UK market. As you guys know, I'm not very bullish on the UK market. I think there's some good opportunities in the UK market and some UK stocks will do very well. But in the long term, or in the bigger cash allocation I always want to have is in the US market, because I do think the UK economy will generally underperform the US economy. So I do have some UK stocks, but obviously I have more capital in the US market, and the UK market I do think is in for a tough ride. But that is clear when you look at the indexes. For the UK side of it, you look at the FTSE 100, it's down -2%. It's not been a good year for the UK market. If you look at the FTSE AIM All Shares, this is down 12% year to date. And if you actually go back even further out than that, you can see the market really peaked in 2021 and it's actually down 42%. So when I say I'm negative on the UK market, it's not like it's not priced in. The UK market has been in a bad place for basically a year and a half now, well, over 2 years now. So it's not like the UK is kidding us here. It's been really beaten up, and you've seen that in a lot of companies. There's a lot of opportunities in the UK market. So I don't mind saying that, yeah, I'm not got much confidence in the UK market, but it's not priced in. You can see here, it's pretty negative on a lot of the valuations at the moment, and I think that'll continue. You look at inflation in the UK, it's still a big mess. You look at true inflation, the actual government reported figures is still 6.8%. That's going to take a while to come down. That's going to mean interest rates have to go up. And when you look at the UK wage spiral that we're going into now, the problem is now the wages are going up so much. So what's going to happen? Well, everyone's going to put the prices up again to kind of combat this wage growth. And what are we going to have in the UK once again? We're going to have a spiral of inflation because of the wage inflation, and once again interest rates will go up. I'm not very confident on the UK market. I think we're in a very tricky space where inflation hasn't come down quick enough. We're now having wages go up rapidly as well to combat this, and then that's also going to lead to inflation probably holding or hanging on for a very long time. So I'm not very confident in the UK market. You look at the GDP growth, we're basically just scraping past here, avoiding recessions at the moment. I think that very quickly, when you're only putting in 0.2% GDP growth, I don't think it's going to take too long that if we see these higher interest rates start coming up more and more, we do see that negative GDP growth that pushes us into an actual recession in the UK. But that's been my opinion for a while on here, as you guys know. The difference is the US market. I've been quite confident on the US market. However, unfortunately, that's really started to change in the last month, and even today, there's just more and more information that's coming out that's making me go a little bit more negative into the S&P 500 and the US stocks. And the difference is, when you look at S&P 500, we're basically near all-time highs at the moment. So when we talk about the UK market, the UK market isn't really near all-time highs. The market is having, the FTSE is not too bad, I guess, but it is negative on the year. The AIM is basically, lower than where it was in 2020. So that's obviously getting priced in. But the S&P obviously is pretty much near all-time highs at the moment. But I'm seeing more negative stuff come out for the US market that makes me go, Can we really push to new all-time highs here, or we're going to head lower? And the example for that is obviously, the big thing is 5 stocks basically are covering a lot of cracks at the moment. Nvidia as well, particularly being one of them that's driving up them S&P gains to make it look better than what it is. And on the valuation basis, it's very high. Look, we're about the highest that we've normally been for a long time on an average. Not on the mid caps, not on the small caps. That's why I've always been a little bit more focused on the mid and small caps when buying. But the large caps are still at quite rich valuations. But even today, I'm listening to Jerome Powell at the Jackson Hole, and he was coming out and basically saying, inflation's not done. We are going to have to keep increasing interest rates higher and higher and higher. Interest rates still going up. And it's crazy because, I thought the Fed were going to pause maybe 3-4 months ago, and they've not paused. They've just keep increasing. And the suggestion is, and I don't think they're playing the hard game, I don't think they're just saying it, because I thought they were doing that a few months ago and they've just continued to increase. Even last month I thought they're definitely going to have to pause here, and they're still increased, and it just keeps going up and up. And we are now, the US interest rates are raised to the highest level in 16 years. They've been increased rapidly. I think it's the highest have been increased in the history at the moment. They're going up and they're increasing fast. And at the moment we've been able to avoid a crash or a recession in the US. But if you keep putting those interest rates up, there's no signs of slowing. The Fed at the moment still think the economy is strong, so they can afford to do it. Unfortunately, this will cause a recession in the US economy. You cannot keep increasing interest rates and increasing them rapidly as well. We're not talking like 0.1, 10 basis points hike. We're going for big hikes all the time. And if you keep doing this, money is harder to lend. It will cause a recession in the US environment. And it's at what point are they going to realize that they're going to cause a recession? Because we know the Fed historically is slow to react and goes far too much to the other side. We saw that in the CV times. We saw how much money was printed that didn't need to be printed out there. And now we're getting to the point of view where inflation is actually quite low, and yet they're still putting interest rates up as if inflation was still 8-9%. Interest rates going towards triple what inflation is. It's absolutely crazy, and it will cause a recession. Everyone's talked about a soft landing in the US. I don't think this soft landing is going to happen. The cracks are going to start showing. There's only so much you can keep increasing them interest rates, and at the speed you're doing it, without causing the pain to start coming into the US economy. And I think it's starting to show. July, when you look at the jobs, I always said you won't get a recession until the jobs start cracking. And in July, we started to see the first signs of the jobs start getting a little bit weaker. Now the thing is, we do have another job report coming out on the 1st of September, so we'll have a little bit more detail then. But I'll tell you, if the 1st of September comes around and there's another weak job report, I am a little bit worried. That's, every so often you might get a bit of a blip in a job report. If you get back-to-back weak job reports, that's where it gets a little bit worrying. So that's a key one that I'm looking out for. But I was looking at retail earnings this quarter. The weakness is starting to show in companies' earnings. Look at Gap. They said that they are now warning of uncertain consumers. If you look at the likes of Macy's, they're saying they're starting to see demand being hit. If you look at Foot Locker, they're starting to see weak sales. If you look at Lazy Boy, a furniture shop, they're saying weak sales as well. And there was plenty of other examples that we could have used that retail consumers are starting to be a little bit more cautious with the spend. And it goes back to the one thing that we just talked about. It's going to happen. If you are increasing the interest rates more and more at a rapid pace, this is going to affect the consumer where they stop spending because the costs are just going so high. And you top that off with weakening jobs and uncertainty around jobs, that is where you start having a major pullback in spending, and it causes a recession. And I thought we'd be okay. I thought we would see the pause about 3 months ago, but it looks like it's not happening, and it looks like it's going to be even further away from the pause. We're going to see the interest rates go up. And this is the thing, like I always said, the biggest fear, and my biggest fear in the stock market was the Fed and Jerome Powell, because they historically don't make the right decision, and I don't think they'll make the right decision this time when to start pausing. And it looks like they are nowhere near pausing, and if they keep doing this, the pressure will pile onto the consumer. There's only so long you can do it with the economy holding up. If you keep putting those interest rates up higher and higher and higher at the fastest ever pace that we've seen, it will cause a recession. And my big fear now is that we are starting to see those fears. We're starting to see the jobs growth get a little bit weaker. We're starting to see companies, not just one company, multiple companies starts warning that they're seeing consumers spend less and less and less. That will then knock onto the jobs once more, and this is where I'm starting to get a little bit worried now. I'm starting to see the cracks, the so-called soft landing, start to disappear. And for me, this is the most worried I've been, because the power lies with the Fed and Jerome Powell, and historically they make the wrong decision. And once again, history is repeating itself. They look like to be making the wrong decision, and if they carry on doing what they're doing and they do that for the rest of the year, I do not think we're going to be in a good place, and this is why I am worried at the moment. So I'm not all panic stations at the moment going, I'm going to sell all my stocks overnight. But what I am saying is, compared to what I am normally like, as you guys know, I am normally very bullish on the stock market. However, it started to change in the last few months. This is the most worried I have been in the stock market, and this is me being a little bit more cautious going, I am worried about where we are headed. I am worried that if we have more and more Fed hikes up in the next few months, we are going to see the cracks in the economy and the potential of a recession. So for me, I am being a little bit more cautious than what I have normally been. And it also does mean that I need to just be a little bit more protective of what I do in the stock market going forward. And this goes down to 3 points now. So the first one is sell. Am I going to sell everything? No, I'm not going to sell everything. No, I always say, even if I'm negative on the market, I can't time the market, because what happens if I'm wrong, right? What happens if the Fed just played me and they actually come out next month and say, actually, you know what, we're not going to hike up interest rates, and all of a sudden everyone's like, whoa, hold on, like it sounded like you were going to hike them up more and more, and you turn out you're going to pause now. Maybe the inflation data comes in good, and they go, we're doing okay here, we're actually going to pause. That's the thing. Like, the worst thing you can do is time the market. Like, you would have seen that in 2022 when everyone was really bearish on the market. So many people tried timing the market and jumping out and then trying to jump back in, and they missed that big rally up. And that's an example of, like, okay, you might be bearish, but you never try timing the market. And that's the same for me. I'm not going to try time the market, but saying that, selling wise, I do want to be quite protective of if there's any stocks that I think could potentially get really hit major. You know, do I look at a bit of a trim? Do I look at any stocks that potentially could get hit hard or generate any cash? You know, the likes of Lovesac. You know, I was worried about Lovesac as a company because we were going into a high interest environment, and I thought, are they going to have the furniture sales? You know, if the interest rates are high, are people going to go buy, you know, furniture? If people aren't buying homes, are they going to go buy furniture? And I sold that one out for a gain. And then once again, I'm looking at these earnings from Lazy Boy, and obviously the furniture company that I showed you earlier, and they're showing weak sales. And any kind of companies like that, I'd be a little bit like, it could get a lot worse for them. So I'm trying to manage that situation, which you've seen. I've kind of sold that stock there. The next thing, and the big thing, this is the big change that I'm going to be making in the next 6 months. Cash. For the last year and a half, I have had no cash pile. I've basically put all the cash that comes into the portfolio. I've been buying opportunities. I've been buying HIMs at $3. I was buying DraftKings at $10. Any stocks that were really, really low in the last kind of 6, 12, 18 months, I've been buying and buying and buying. Now, realistically, DraftKings, I'm up on DraftKings. HIMs, even though it took a beating, I'm still up on HIMs. I've been buying a lot of stocks at the moment, and for me, I'm pretty happy where I am with most stocks that I own. There's one or two that a few changes, but that's a different story. I'm quite happy. So for me, I'm going to be a little bit more cautious where I'm not spending everything that comes in. My aim is probably to get up to, say, something like maybe a 10% cash pile. And that's in case that if there is the cracks that start showing. And the big thing is, if those 5 stocks, which are Nvidia, Apple, Amazon, Netflix, Microsoft, you know, if those big tech stocks, if they're the ones that do have the pullback, that's where the market will lose it. That's where the market will really panic. It's like when we were in 2022 and there was, and 2021, the market weren't bothered that all the small caps were diving off a cliff. But when the big tech joined in, whoa, the whole market dragged down. And that's the same thing. We've already seen the likes of that with Apple. Their earnings have already shown a little bit of weakness, and I'm surprised the likes of Apple hasn't been dragged down more off those earnings. But if the market all of a sudden starts panicking a little bit, that might have a bit of a reality check. So the big change is that I am going to start trying to stock up a bit of cash pile just in case, which I've not done for a little bit. Basically nearly 2 years now. The next one is short, is that if I do think the market is going to go down, is the potential that I do have some sort of protection for the market going down. Because let's say that I'm wrong. Let's say that, okay, the Fed pivot or the Fed still carries on doing the interest rates, but the economy holds up. Let's say I'm wrong, because I'm a little bit worried at the moment, but let's say I'm wrong. If I am wrong, I won't be bothered because, like I said, I'm not going to try to time the market. I'm still going to have all my investments. So if the market does go up, I will still make money because I'll still hold my positions. But if I am right and the market does take a little bit of a wobble because of these interest rates and it does start affecting the economy a little bit, and we start seeing the market panic a little bit, we start seeing the recession word used more and more, and there's more and more fears, and the stocks start going down, especially the ones that are a bit of a higher valuation. The Nasdaq in particular, that's had a crazy run up. You look at the likes of the S&P 500 as well, and there's a few stocks in there. I think Apple is a very rich valuation. I know a few people don't like it when I say it. In my opinion, Apple is very rich. It's historically a very rich valuations. The growth is nowhere near to justify the valuation it's at, and if there's going to be a recession, people are going to be even slower to buy new laptops and buy new iPhones, and that's going to be one stock in my opinion that wouldn't do very well. So if that's the situation, is it best that I have a little bit of coverage? So if it does go down, I've got, I knew it was a bit of a worrying time, and some of these stocks do start going down. At least I'm making money while that's going down, and then eventually, if stocks get to very low levels, I can sell that position out, that position I've got for a bit of cover, and then I use that cash to go put it into something that's a cheap valuation. That does really seem to make sense. And at the end of the day, like I said, I'm not going to sell all my stocks out. I'm probably not going to sell anything out. I'm not going to try to time the market. I'm just going to be a little bit more pulling back what I'm buying. But if I'm pulling back what I'm buying and then the stocks do go up, I'm still going to make money from here. But if the stocks do go down to more attractive valuations like they were in 2022, I'm going to have cash to buy, but I'm also going to have maybe some coverage that I have made money, and then I can use that for even more cash to go buy something. That kind of makes sense to me as well. So ultimately, overall, what I'm going to say here is that I'm not timing the market. The stock market might go up from here. The stock market might do very well. It might not be a recession. We might still get this soft landing, even though interest rates probably will go up. And because I didn't time the market, I'll still do very well. But I'm also going to be a little bit cautious, because for me, like I said earlier, this is the most negative and the most bearish, or the least bullish, I would say. I won't say bearish, but maybe least bullish that I've been for a long, long time. So with that in mind, if I do think the market could go a little bit lower, the cash is there ready to deploy for opportunities. And potentially, what I will be looking at in the next coming few weeks is an opportunity that if the market does go down, I make money. But at the same time, if the market goes up in the longer term, if we do have a very good 24 months, I'll still make money from the stocks going up, and then I make best of both worlds there. That's what I'm kind of thinking. So I thought I'd just update you guys with my thoughts at the moment. And I don't really like making these sort of videos, because me, I'm normally the one that's out there going, it'll be okay, and it will be okay in the long term. And if there's any opportunities, go buy those opportunities in the stock market. But for me right now, I look at the market and going, for me, I see more negative things to be bearish on than bullish on. And I look at the S&P that's been propped up from a few stocks and thinking, if those stocks start crashing and these interest rates keep going higher and higher, and this job data comes in weak, another month after month after month, I don't know. It's just there's a few things there at the moment that I don't like. Like I said, nothing that for me that I'll come out and say, I'll never be one of those people that come out and say, I've sold all my stocks and I'm going to try to. I never do that. I would never do that, because it's impossible. And sometimes when you think it's going to go one way, it can go the other way. But for me, I just want to be a little bit more cautious than what I have been in the last year, because I am seeing a few things I don't like out there. Hope you enjoyed the video anyway, guys. Let me know what your thoughts are at the moment. Do you think we are in a good place? Do you think we are in a bit of a bad place or heading to a bad place? I'd like to hear your thoughts as always as well, guys. Hit that like button if you're around here, subscribe. I'll catch you in a bit.